look at it this way. The last year that you earned income here, meaning your inflation adjusted income, this isn't an increase in lifestyle, by the way. This is what you're going to need to earn 30 years from now to be able to maintain the standard of living that you're earning today, right? And if you put your money into qualified accounts, right, this savings, this growth, this compounded money of $760,000, that's not all yours. That's going to come out. So you're still going to have taxes. You're probably, unless you've done really good at saving and managing your lifestyle and servicing your debt, you're probably going to have roughly the same debt servicing and lifestyle expenses, because guess what? These are just the way. It's hard to teach an old dog new tricks, right? So these are the habits and the systems that you've built into your financial life. So you're going to get to retirement and you can have all the best goals in the world that you want, but you're going to get there and you're going to be still dealing with the same problems. Hey, what's going on, cash flow hackers? It's Chris with Life 180. And for this video, I want to talk to you about your maximum potential when it comes to your money in your life, how you can get there. And this background that I have here is actually my computer screen. It is a calculator that I'm going to walk you through, and I'm going to talk to you about how what you're being told is actually wrong about how to reach financial security, financial freedom, retirement, whatever you want to call it. The reality is, you look around the world right now, 95% of the people are either behind pace of reaching retirement and being able to maintain their standard of living, or they're reaching retirement and having to reduce their standard of living or continue working, one or the other, right? And so when you look around, it's no wonder I always call 401ks the greatest financial failed experiment of all time, because of the fact that people are relying on it and they're following the principles that are implemented inside of 401ks. And ultimately, those principles are what is failing people. And so for this video, what I'm going to really dive into is talking about all the moving parts of money that have an impact on us reaching our financial freedom as quickly as possible. Now, I am going to take a 35-year-old and I'm going to have it work out 30 years, looking to retirement for 30 years. Just know that as I go through this, I don't believe that that's what anybody should be doing. In fact, I wrote this book called Cash Flow Hacking, showing how you can reach financial freedom in a decade or so, utilizing cash flow investing. Now, this is not getting into that. I got plenty of other videos on that topic. If you want to get a copy of that book, you can go to Amazon and you can pay $19.99 for it. Or you can go to the description below. There's a link down there, cashflowhackingbook.com. Click on that link and it'll bring you to a page. You can get the book for free. All I ask you to do is to pay the shipping and handling charges, and you will be good to go. So now, and what we're going to do is we're going to go through this. So I'm going to illustrate out 30 years. Okay. I'm going to say that I have a 35-year-old and they have 20,000 in current assets. And I'm going to say they have an annual income of $100,000. Okay. So what does that mean? That means, now you could see here that shows that this person has $3 million of money flowing through their life over the next 30 years. Now, I don't know about you, but I don't know a lot of people earning $100,000 at their job after taxes, after everything's all said and done, that can really relate too much to $3 million, right? And so that since he's got $20,000 saved already, you could see the total growth potential is $20,020,000. Now, this is just saying if they didn't have to spend any money, if they were able to save everything that they possibly earned and had no expenses, this is where they would be. Now, we obviously know that that's not the case, but there's some variables that come into play here. So what I have here is an increase box. And what this is basically saying is, what is your increase in income going to be on average over time? And so what I'm going to do is actually, I should put 2.5%, because that's about what it is. But inflation over the years is about 3%. Now, that is just the way it's been on average historically. Inflation is about 3%. Typically, over the past 40 years, the wage growth has actually trailed inflation a little bit. So, you know what? From that perspective, I am going to put 2.5%. I'm not going to just doctor this to make everybody feel better. We're just going to be realistic about the numbers. Now, what does that mean? Based on 2.5% growth, that shows year one, you're earning $100,000. You have a total amount of money of $4,390,270 going through your life. And that just goes to show year 30, based on that 2.5% inflation, you're going to have an income of $204,641. Now, what does that mean? Well, there's a couple things that go into the equation here. So now this is showing also that this is if you saved every dollar. Remember that. If you saved every dollar, obviously that's not an option. So let's just say you were to take that money and invest it because you were able to save every dollar. And believe me, trust me, I'll work this backwards, but it's important that you understand this. If you were to save that money and earn 4% on that money, that means you now have a total of over $8 million going through your financial life. Now, I definitely don't know any people making $100,000 that could visualize $8 million. Maybe they could visualize it, but they can't really imagine tactically $8 million flowing through their life at this very moment in time. But the reality is that is what's going to happen for you. So, but here's the problem. Lifestyle happens, taxes happen, debt happens in our life. And because of the way that we live our lives, the way that we service our debt, the way that we manage our taxes, the reality is it just, it is what it is. People are inefficient with their money, right? So let's just go across the board. Let's say you have a total taxes of 30%. And so you can see already what that does to your life. The cost of taxes actually reduces the maximum potential as far as growth in your life. That number has already shrank, right? So now the compounding there has gone down. The total cost of taxes you can see up here is $1,317,000. The actual loss because of opportunity cost and what that could earn for you otherwise is $2,383,000, right? And so that's that. Now the other thing is people are spending about 30% of their life on debt servicing, right? Now, I'm going to keep this straight across the board. It's a little different for everybody, but I'm just, for the sake of this, the average home right now is spending about 34% of their income for debt servicing, according to a Bankrate article I just read. That is what it is. But you can see with the debt servicing, it's going to be the same across the board. Now, your lifestyle is actually going to be about 35%, because if you think about it, you're making $100,000. That means you're living on $35,000. But when you take that all into consideration, the one thing I could probably do here is reduce the taxes to 25%, realistically speaking. And that basically means that your lifestyle total cost, you're going to spend on lifestyle $1,536,000. And the actual loss of that, the opportunity cost of your lifestyle is $2,780,000, right? And so when you look at these numbers and you look at the potential, here's the bottom line. Now, there's a couple variables to think about. We're doing this at a 4% earnings rate on our savings, right? Here's the problem. When we look at inflation, the numbers get worse, because let's pop in inflation at 3%. Right? So what does that do to our money? It means our money is going to be worth less. So what we're able to actually accumulate is impacted, right? So what happens is we have all this money, this almost $8 million in income is going to go through our lives. And at the end of the day, by saving 10% of our income, because that's what's left after the 35, the 30, and the 25, that's a 10. Because if you saw here, if I change this to 30%, this is going to be 5% of income saved right there. So I'm going to pop that back to 25%. So now this is following the idea that most people are taught. Save 10% of your income, let it grow, let it get where you want to go. Now, of course, you're looking at this and you're going, okay, Chris, don't be silly. You're not going to get just 4% on your money. Okay, I'll concede that point to you. And let's say you make 8%, because that's what your advisor tells you can get when you buy and hold long term. Well, guess what? If you're 30 right now and you're saving 10% of your income and you get 8%, and let's just say to get 8%, that's net of all expenses and fees. That means you're earning between 9.5% to 10% every single year. Honestly, not a realistic expectation. You shouldn't be banking on that. If you do, you're in trouble. That's the reality. So look at it this way. The last year that you earned income here, meaning your inflation adjusted income. This isn't an increase in lifestyle, by the way. This is what you're going to need to earn 30 years from now to be able to maintain the standard of living that you're earning today, right? And if you put your money into qualified accounts, right, this savings, this growth, this compounded money of $760,000, that's not all yours. That's going to come out. So you're still going to have taxes. You're probably, unless you've done really good at saving and managing your lifestyle and servicing your debt, you're probably going to have roughly the same debt servicing and lifestyle expenses, because guess what? These are just the way. It's hard to teach an old dog new tricks, right? So these are the habits and the systems that you've built into your financial life. So you're going to get to retirement and you can have all the best goals in the world that you want, but you're going to get there and you're going to be still dealing with the same problems. So what's going to happen is you're going to end up with $760,000, but you need $204,000 a year. So even after Social Security, if it's there in the first place, you're going to be in a position where you are in trouble. Deep, deep trouble. You're either going to have to continue working, you're going to have to reduce your lifestyle, you're going to have to make some huge concession in your financial life to be able to make it work. All right, so let's get to being more efficient, right? Like one of the things that I always kind of talk to people about is like, okay, so you can see here, just hypothetically, remember, just to go back, I had 4%. Which got us almost $60,000. I bumped it to 8%. That got us to $760,000. Listen, I'm not comfortable with anybody going above 8%. Dave Ramsey likes to talk 10%. That gets you to 1.143 million. That's still not even nearly enough, guys. That's gonna it's not gonna solve your problem. At the end of the day, that's what I'm talking about, is how do we come up with a way to solve your problem? Now, the taxes, what I'll say is I'm also worried about taxes right now. We're at this all-time low tax rate environment, and we're at all-time high debt environments, and we're at all-time low interest rate environments. There's going to be a lot of pressure. When interest rates go up, there's going to be a lot of pressure on the government balance sheet. There's going to be a lot of pressure on the government in general. They're going to have to raise taxes to, fund the gap that's going to be caused by the added required revenue needed to be able to sustain, all the extra interest payments for the debts and all these things that are going on. So when I look at that and I look at taxes, that's why I say, I think right now you may be in a 25% tax bracket, but I personally believe that people in a 25% tax bracket are going to go to, a 30 or 35% tax bracket when that happens, right? And so I'm not going to put it in there right now, I guess. But the bottom line is, when you look at that, when you get to retirement, this could actually be worse than what I'm showing you. Here's the bottom line. What we need to do is we need to regain control of our money. We need to not put it into accounts that we're giving up control of that money and putting it into an account where we're deferring taxes into an environment where we're going to end up ultimately paying more in taxes. And so what I'm talking about here when I talk about taxes is lifetime tax liability. If we could come up with a strategy that reduced our tax liability by, let's say, 10%, and I'm not saying drop it from 25 to 15, I'm saying drop it from 25 to 22.5%, right? Like a 2.5% reduction in overall tax expense is a 10% reduction. So you could see that 760 number, just by reducing my taxes, goes up to 921,000. So by focusing on increasing our tax efficiency by 10%, that's it. We have an extra almost $200,000, right? If we can be more efficient with our debt servicing and come up with a strategy where we can have a system where more of our money flows into it. This is where, when I talk about infinite banking, people are so focused on the internal rate of return and what am I going to get for returns inside of the policy. And, this is where, I talk about utilizing the policy to get cash flow assets in my book, Cash Flow Hacking. But even aside from that, what's really important is understanding a financial system where you're gaining control and recapturing control of money that you're losing unknowingly and unnecessarily. And in doing so, what if we could take this and over a short period of time, over the next 5 years, reduce your debt service to 20%, and you lived on that. Now all of a sudden you got 1.565 million. And then what if we could get that down? And this isn't going to be as clean as maybe I want it to be, because it doesn't do it year by year. But let's just say I reduced it to 15% over the next 5 years and just operated more efficiently, right? That's you're now at $1.8 million. And guys, I'm telling you, this is the importance of just operating more efficiently, because the important thing to see here is, if we go back here and we go back to the 25 and the 30, if we go back to what everybody else is doing, this is what you're doing right now. This is why when we talk about infinite banking, why we talk about how the rate of return chasing these big returns doesn't matter because we got 760 right now. I'm going to pop this back to 4% just to prove a point. And let's now go 22.5. Let's go, if the infinite banking strategy can help you eliminate your debt service and make it so you recapture your money in the next 5 years, and that goes to zero, and the money that you were spending on debt servicing goes out the window, and now you're recapturing that money. What happens? Now all of a sudden, with no debt service, just with the money flowing through your life, this doesn't even account for the fact that we can help you bake in positive arbitrage to everything that you have going on. You're already at $1.423 million. And now what happens to your lifestyle, because of that, you're able to bake in that positive arbitrage. Your lifestyle actually gets better, and you don't have to reduce it. It is what it is. And here's the deal. This doesn't take into account that you can utilize and get returns outside of this. This is what you can get on a guaranteed basis with no risk. Remember, the other way goes into taking a lot of risk on, right? And it's almost likely, in fact, that you're not going to get there. Not only that, is the other way, you're putting money in tax deferred vehicles and that's going to be taxable. So the 1.8 million was actually not 1.8 million. You have to take the fact in, you pull that money out, that's going to be taxable. This is all going to be tax-free access to this 1.4. So you actually net have more money right there, right? Like that's an important thing to understand. And so, you know what, when it comes down to it, I look at this and I go, you know what, if you can just focus on being more efficient, that's where the success is. Over the next 5 years, what I would say is, yes, you want to get into cash flow investing. You want to stop with the buy and hold nonsense that's being taught to people, because I showed you already, if you do that, it's almost guaranteed that you're not going to get where you want to go. So you need to think about cash flow investing. But in order to do that, we have different stages. I'm a big believer in cash flow investing and passive income, but sometimes you have to go through an active stage of income generation to get there. Now, that's another video, it's another concept. But if we can focus on step one, is eliminating all toxic debt and cleaning up our financial house. That's what I talk about in my book here. I go through the 9 stages of creating financial wealth. And as I do that, I'm seeing if I can find it in here. Nope, well, it doesn't matter. It's in here, I promise. You can go check it out. The first stage is having clarity on where you want to go, and then eliminating all toxic debt and making sure you increase the financial efficiency in your life, right? Like that is the most important part. And by doing that, this 1.4 million just becomes a foundation. You can start investing in other cash flow assets. And I'm telling you, there's no reason you can't reach financial freedom, honestly, in the next 10 years or maybe 12, depending on where you're starting. But like typically worst case scenario, it's 10 to 12 years, right? And so that is what I know. And when you look at these numbers, it really becomes kind of a no-brainer. So if you haven't already, make sure you click that subscription button, click the bell that way you get notified every time I launch a new video. And I hope you found value in this, because I am really looking forward to creating a lot more content on this topic. So till next video, have a blessed, inspirational day. We'll talk soon. See ya.